Developed or emerging markets?
Okay, through the lens of innovation, given that the U.S. is the leader in innovation, I'm going to say developed, but emerging markets are very industrious and eager to catch up as well.
Would you lose all your crypto passwords or your brokerage account login?
Which would I prefer to lose? If I had to lose one, well, it probably has to be the one. It's very hard to tell because I'm half and half crypto, and just to give you a sense, half and half crypto and equities, hardly any bonds. So given that I think crypto is going to stun the world, at least the way I've positioned in certainly Bitcoin, the biggest, if I had to, I'd prefer to lose the brokerage account.
Yeah.
Is AI under or overhyped?
AI is, I think people, thanks to the ChatGPT moment, understand how provocative it is. But I don't think they understand how profoundly it's going to change our lives, especially healthcare.
And this one is easy. Sweden or Switzerland?
Okay, I am, my lens is always innovation, so forgive me. And I associate the two with different kinds of innovation. Mm-hmm. So in Switzerland, we know that the pharma industry is a big deal there. And crypto, financial services are as well. So crypto, it's very important for those pharma companies to harness AI and all of the new technologies. But crypto, they're doing a really good job with. Sweden, I have associated all my life with technology. In the 80s, when I started in the business, Ericsson was, I think it was late 80s, Ericsson was unstoppable and taught us all how important R&D was. And we were really impressed by the reinvestment in R&D. So I've always thought of Sweden as very tech forward. So I hope that helps.
Dog or Doge?
Okay, so maybe controversial, but I'm a little scared of dogs. So I have to say Doge, but here's why. Doge is all about making government more efficient, bringing down government spending. Government spending is taxation, and it's either taxes now you pay for what you're spending, in the future your children or grandchildren pay, or most regressive tax of all, inflation is how you pay. So I actually think Doge is a good thing.
Europe or Asia?
Okay, again, lens of innovation. And I'm going to qualify it. I understand where I am right now. Asia is much more rapidly adjusting, I think, to the new technologies that are evolving today. Europe is being held back by regulation. However, there is hope. We were impressed that Europe provided much more clarity for crypto or digital assets with the MiCA legislation, way ahead of the U.S. So a question I get here a lot in Europe and the U.K. is why aren't we seeing more innovation coming out and a deeper market for venture capital? I think half of the solution is understanding the problem. And I'm hearing even policymakers asking that question. And I do think in the years ahead, there's going to be regulatory arbitrage where countries will start competing with one another with a better regulatory framework. I think the world went way too far after the various crises we've been through, tech and telecom, financial, regulations just strangling innovation. So I think there's hope for Europe.
Bull or bear?
Again, through the lens of innovation, I have never been more bullish. And one of the reasons for that is if you look at the financial markets really over the last 4 to 5 years, and the equity market in particular has performed in a very narrow way. Very few stocks delivered the bulk of the performance. In fact, if you look at the Mag 6 over the last 5 years, they're up 5-fold, while truly disruptive innovation, not saying that they do not innovate, but truly disruptive innovation is up only 30% if we look at that segment of the market. We think those places are going to switch going forward. So very, very bullish.
Meme stocks forever or blue chips only?
Meme stocks, you mean meme stocks, or blue chips only.
Yeah.
Okay, when you first said it, I thought meme coins.
No, meme stocks.
Oh. Well, if I had to choose, it would be the blue chips, because I don't understand why some of these stocks are meme stocks. They're, whether it's AMC or the other one, I've forgotten. As you can tell, we do not invest in these meme stocks. When I look at them and I try and understand, their future and their future cash flows, I don't see it for the most part.
GameStop is another one.
Oh, yeah. GameStop. Yeah, exactly. It's like choosing the old world over the new world. I don't get it.
Live off dividends or hope of exponential growth?
Right now, exponential growth. No question in my mind about this. The search for yield over the last, since interest rates went up so much, has gone to an extreme, I think. And we've seen equity inflows into that part of the market. And it really just tells you that the bull market has not been that healthy. There's a lot of fear out there. We think that the exponential growth opportunities are going to cause not just exponential growth, but super exponential growth, because we've got 15 different technologies converging to create autonomous taxi platforms. So you've got, there are 3 of them there: robotics, energy storage, and AI. 3 major innovation platforms. Each one has its own S-curve, and now they're intersecting. One is feeding the other in the form of autonomous taxi platforms. We think that's an $8 to $10 trillion opportunity globally in the next 5 to 10 years. Mm-hmm. So exponential growth all the way.
What will come first? Bitcoin reaching $1.5 million USD or Tesla reaching $2,600?
We have in our Big Ideas 2025 forecasts for both of those, as you say. So which one do we believe will get there first? I have to say Tesla. Hesitantly, though, because the distance between here, say $330 and $2,600, is less than the distance between 104,000 and 1.5 million. But our confidence in both is very high. Just want to emphasize that.
Cathie Wood, you are the founder and CEO of Ark Invest.
Yes.
Welcome to Avanzapodden.
Thank you. I'm delighted to be here.
You've said that the Trump era would be the golden age for Wall Street. Could you elaborate on why you believe that?
Yes, this is a bit of a deja vu moment in my own career. This period reminds me of the early days of Reaganomics in the early 80s. And Reagan was cutting taxes, deregulating, and focusing on getting interest rates down. Trump is getting tax rates down in more ways than Reagan did, in that he's trying to get tariffs down. So if you look at the 80s and 90s, those were the golden age for equities. I think we could be entering into another period like that.
How does Ark Invest navigate through the current geopolitical situation and the trade tensions, of course, in this investment strategy you have at the moment or always had?
Yes. So our strategy is volatile, more volatile than the market. And that's because these are long duration strategies. So they do get hit harder during turmoil. But the ironic thing is when consumers and businesses are afraid or concerned, worried about the future, they're more willing to change the way they're doing things. So better, cheaper, faster, more productive, more efficient, more creative products and services. That's what we do. So what you usually see towards the end of a correction or a bear market is our stocks tend to start outperforming before the broader market does. And that has happened in this time as well. We went through tariff turmoil. We went down more than the market, and now we're up more than the market. And the question now is, will this be sustained? If we're right that we're moving from a rolling recession to a strong recovery with surprisingly low inflation because it's going to be productivity driven. I think we're in for very good days for innovation, all kinds of equities, of course. But, our stocks over the last 4 years have faced 3 major headwinds that are going to turn into tailwinds now. Would you like me to go through them?
Yeah, sure.
Yes, please.
Sure. So the 3 headwinds have been, first, the interest rate shock in 22. Now, just because interest rates go up or stay up, it usually doesn't bother our strategies. If you look at 2017 and 18, the last time Trump was in office, interest rates went up, and we way outperformed the market in both 17, which was an up market, and 18, which was a down market, and our flagship strategy was up. It was the shock of the interest rate moves. We're not going through another one of those. That headwind is done. The second headwind I mentioned earlier, which was the concentration towards a very few stocks, and therefore what I describe as an unhealthy, not broad-based bull market. That we think is changing. We started to see it upon the election of President Trump. Then we had tariff turmoil and we had the backtracking. And now we're seeing it again. So, and then the third headwind is a valuation headwind. At the peak in 2021, our portfolios sold at a 275% premium to the S&P when measured using enterprise value to adjusted EBITDA, adjusted for SBC and R&D. And we've worked with S&P to get that metric. So 275% in February of 21. Today, we're somewhere in the 10 to 15% range relative to the S&P 500. On average, through Ark's existence since 2014, we have sold at a 90% premium. So we are well below average, well below pre-COVID. So that headwind is gone as well.
But what kind of horizon do you think an investor need in order to be invested in innovation?
Well, our own investment time horizon is 5 years.
Okay.
And, our modeling often goes out beyond that. But we have to believe that that the market is going to start discounting the opportunity within 5 years. Yeah. Mm-hmm.
So let's discuss Tesla. Tesla is not only Ark's largest holding, but it's also the second most owned US stock among our customers. So I think both you and many of our customers has conviction in this stock. How do you assess Elon Musk's impact and in his other engagements outside of Tesla and its performance?
Yes. It's very interesting to me that this is the number 2 holding among your client base, because we know there's been a lot of negative sentiment about the brand. So isn't that interesting? I've been surprised to learn that. So that gives me hope. As I said, you've got a very tech-forward investor base, I would say here. Elon Musk, and I am on record saying, yes, there has been some brand destruction, but we're also in a macroeconomic downturn. The first quarter was negative for the entire U.S. economy and many parts of the world. Second quarter may be the same because a lot of businesses have been paralyzed by the tariffs. But I think that the news cycle is passing quickly in the U.S., and that many people are beginning to understand that Elon is pulling back from the government, having put his people in place there to get the job done, and is going to focus much more. He committed today, actually, to 5 more years at least. And I believe the reason he did that is because not only does he want to see the robotaxi proliferation throughout the United States and perhaps the rest of the world, but he also wants to be at the vanguard of humanoid robots, and he thinks Tesla is going to be number 1. As far as his other companies, as we've gotten to know Elon, his modus operandi is this. He looks at a problem to be solved, whether it's in the government or in his various companies. And with his team, he figures out, using first principles, not relying on any past history, how quickly something should happen, and sets milestones along the way. When one of his companies starts missing those milestones, as the Model 3 production did in 2018 and 19, so-called production hell, you will find him sleeping on the floor in the factory. He becomes maniacally focused on whatever the bottlenecks are, whatever the gating factors are. And those bottlenecks happen at different times in different companies. So that is why all of his companies have performed extraordinarily well. Now, you might say it's been a tough patch, from a volatility point of view for Tesla, but that's been true Tesla's entire history. We still have auto analysts primarily on the sell side of the street following it. And it should be a completely different kind of analyst. It should be a robotics analyst and a battery analyst and an AI analyst. We have 3 analysts on Tesla. So I think the volatility is because it is not well understood. And that's why we give our research away. We put our models out there just to help educate.
Can we take a follow-up on the robotaxi of Tesla? What are the risks and threats that they will not succeed with the robotaxis? Because that's a quite big part of the valuation in Tesla at the moment.
It is. Well, I think the odds have gone down now that, and in fact today, Elon reiterated that Tesla is launching its commercial robotaxi service in Austin in June. So that's good. We have seen the odds of failure go down with every update of FSD, full self-driving. Now, your listener base, unless they're in the United States, is probably not familiar with FSD because regulators are not allowing it here. But I can tell you in St. Petersburg, Florida, where Ark is headquartered, I can leave my apartment building and just tell my car where I want it to go, and it will do everything for me, including parking. That was a weakness before, but now we've got parking down. So I can see that they're ready for prime time. One other metric we monitor is where FSD is relative to human driving. And if you look at the miles between critical interventions, Tesla is moving toward that 700,000 miles that is characterized by human drivers, miles per intervention. Elon and team believe that FSD, and therefore robotaxi, will surpass human performance this fall. That's why I believe he has been willing to launch the commercial service in Austin, just to get the ball rolling, or the car rolling, I guess, in June in Austin.
Let's go back to Bitcoin. You said that it could reach $1.5 million dollars. Yeah.
Million. From your lips to God's ears.
Yeah. Right? What are the key drivers for that?
The key drivers, there are three. The first is it is becoming a substitute for gold in terms of a store of value. Younger people prefer Bitcoin than gold. And I think they do believe that it is basically the same thing. Both of their prices are determined by scarcity value. And in the case of Bitcoin, right now we're moving towards 20 million Bitcoin having been minted since the beginning of its existence in 2009. The number that it will be in existence ever is 21 million. So only 1 million more to go, which is about $100 billion. So scarcity value is becoming more important, especially since for the first time, Bitcoin supply growth dropped below the long-term supply growth of gold, which is 1%. With the latest halving last year, the supply growth now is roughly 0.9%, and that will continue to go down with time, which is unlike gold. If the gold price keeps going up, that supply growth will pick up in its pace. That cannot happen with Bitcoin. The second reason is institutional investment. Now, Bitcoin it represents three things. It's a technology, so the blockchain underlying Bitcoin, which is a layer that the internet missed out on in the early 90s because developers had no idea financial services would take place on the internet. So now that is now being put in place. It is a store of value, as I just described, the reason why most young people are attracted to it. And it is a new asset class. It does not behave like other asset classes. Sometimes it behaves like the NASDAQ. Sometimes it doesn't. Sometimes during the regional bank crisis in the U.S. in early 23, it boomed because everybody understood no counterparty risk here like the banks had back then. So it doesn't behave like any other asset. And that means that institutions and asset allocators have a duty to assess whether it deserves a role in the portfolios or their asset allocation. And if they say no, they better have some very good reasons. So the $100 billion that I mentioned, institutions have to either take up those newly minted Bitcoin, and that's going to happen over years and years, or they'll have to pay up to get holders to sell it. So again, scarcity value will drive or will increase because of the supply-demand imbalance with institutional investors really having very little involvement yet. And so we think this is just the beginning.
But how much of a problem is the volatility for Bitcoin to be a store of value?
So if you look at Bitcoin over time, the volatility was incredible in the early days, 200, 300%. It has been coming down consistently, 40, 50% now. And if you believe in the scarcity value of Bitcoin, just like gold has had ups and downs, you're going to be willing to put up with the volatility. But it's the sort of asset where you put it in your portfolios and then just leave it there. I mean, there's going to be trading around it, and that's great for the exchanges. You know, we're involved with Coinbase. That's great for exchanges. But for individuals and institutions, it's a buy and hold asset because it is in such early stages. And really think about that. Institutions probably have trillions commit to digital assets broadly, and Bitcoin only has 100 billion more that will ever be minted.
But do you prefer to invest in the industries such as Coinbase or buy Bitcoin itself?
Well, personally, I have bought Bitcoin outright. Many of our clients wouldn't let us put it in the portfolios, so others are playing it through Coinbase. Robinhood is developing a crypto strategy as well. SoFi is developing a crypto strategy. eToro here in Europe just went public, and we added it to our portfolios. It has a crypto strategy. So many are forced to go in directly just because their platforms. I'm thinking about advisors now. I realize you're a DTC, so your clients can buy it outright. The last thing that I'd like to add is there is a way to kind of straddle the two, and that, of course, is ETFs. So spot Bitcoin ETFs were approved. The SEC approved them last year. ARKB was one of them. That's ours. And so that is sort of a way to leg into pure play Bitcoin exposure instead of dealing with a wallet or a wallet provider.
So let's talk a little about company characteristics, moats, recurring revenue, stable cash flows. These are some valuable traits for investors generally. Is it as important for you and Ark, or do you have a different focus when looking at companies?
So we have a 6-metric system when we're looking at stocks from the bottom up. The first is management, the people, the culture, visionary leaders, attracting the best talent. That is critically important to us. Moat is also very important to us. What is it? A technology moat with patents? Maybe yes. Is it a technology moat because of the speed at which a company is operating and no one can catch up? That also is important. So moat is extremely important to us, and it usually involves technology and technology prowess. And that, of course, means you have to have the best talent. Execution, that means to us, is this company spending enough as a percent of R&D on revenue? And as important, is it spending it in the right places? So just to give you an example, when Toyota decided to pivot at the request of its government from battery electric vehicles to hydrogen fuel cell vehicles, we sold the stock because we had already done the analysis that the infrastructure build out would be way more expensive than electric. So now I think Toyota's even rethinking that. So the other thing with execution, have they attracted the right business partners to get marketing, sales, distribution up and running when the company is ready to scale. And many of our companies are scaling now. And then the last one is product and service leadership. These are the top 4, which we actually score when I say last one. Product and service leadership is market share. There are a lot of statistics like that. But because we give away our research on social media, we see a lot of social sentiment, both good and bad, both polite and not so polite, around our research and support for certain companies and their technologies. The other 2 metrics, critically important, involve cash flow. So enterprise value to EBITDA is our chosen metric. EBITDA adjusted for stock-based compensation and R&D. We've worked with S&P to adjust both the S&P 500 and our flagship. And what we assume, given that our stocks typically sell at a premium, a significant premium to the market, on average 90% premium since Ark was founded, we assume that premium is going to compress or decay to a market multiple in the next 5 years. And we must assume that the combination of revenue growth and margin expansion, which of course turns into cash flow, is going to overwhelm that valuation compression to deliver a minimum 15% compound annual rate of return over time. Now, historically, if you look since our inception, our return has been 11% over time. Well, our forecasts are very dependent on unit growth, and we had a major problem in the middle of our existence, and that was called COVID and the supply shock around supply chain bottlenecks. So we're on the other side of all of those, and happily so.
I think we need to wrap this up. Do you have any last question?
No, let's wrap it up. And one thing I admire about you, Cathie, and the team at Ark is your commitment to transparency.
Yeah.
Thank you.
Your willingness to openly share all your research, all your insights to the public, to us here in Sweden, to all the world. It truly stands out in many ways. And I think many of us is quite thankful, and it's very valuable, of course, that you do it. So thank you so much for sitting down with us.
Well, I thank you for the amazing partnership we have with Avanza. Your clients have exposure to innovation, a really diversified exposure to innovation in a way that most others do not, my guess is, in Europe generally and maybe even in Sweden.
Yeah, we love equities. I read some number that U.S. households have invested 36% of their equity in the stock market, and here in Sweden we're at 36%. So we're just behind. I'm hoping that we will come by.
And I should have mentioned, I didn't finish the answer on Sweden and technology. It has been a beautiful thing to see Spotify and Klarna, and to hear Klarna, and I realize every one of these companies is going to experience volatility, but they're on the right side of change. To see Klarna basically say, hey, we can pull these software as a service services that we're taking and do it ourselves, because guess what? They were ahead of the game on what we now know as vibe coding. We're all going to become coders. So Klarna, when they made that dramatic action, which I think was almost a year ago now, was onto this idea of vibe coding before most of the rest of the world. So congratulations, Sweden.
Thank you.
Thank you.
Yeah.
And I'm just gonna read the disclaimer too. Tänk på att det kan svänga. Att spara i aktiefonder och andra värdepapper har över tid varit ett bra sätt att få pengar att växa. Men hur det går i framtiden, det vet ju ingen. Det kan både gå upp, det kan gå ner, och det är inte säkert att du får pengarna tillbaka som du investerade från början. Thank you so much, Cathie.
Thank you, Philip and Alexander. Thank you so much.